What if you could invest in stocks that almost always pay dividends and boost your income? Monthly income on which to pay your bills, potentially allowing you to live off your investments. That is something you can accomplish by investing in this select group of companies. Let's look at what Dividend Kings are and how you may use them to enhance their efficacy and get the best return on investment. Pay attention because, while they have the potential for massive returns, there are some drawbacks. Welcome to Cashflow Canvas, where we teach lessons about investment and money-saving techniques. If you want to make your financial future better, make sure to like this video and subscribe to our channel for the latest updates. A Dividend King is a corporation that has increased its dividend payout year after year for at least 50 years, which is twice as long as it takes to become a dividend aristocrat. This long track record frequently implies that these organizations have significant competitive advantages, which create barriers to entry and allow them to generate consistent and predictable profits. Pricing power allows them to modify prices in reaction to market conditions, such as growing costs and consumer demand. Furthermore, management frequently chooses to return profits to shareholders via dividends rather than reinvesting them within the company. Dividends provide investors with a sense of stability because they can rely on income to some extent even when the share price of a stock in the market rises and falls on a daily basis with frequent price fluctuations. Dividends are paid on a regular basis, sometimes for more than 50 years. This consistent, dependable income is especially appealing for retirees who want to know when their next payout will arrive and how much it will be. The income can be used to cover bills and other expenses. Even if share prices fall dramatically, the need to sell shares during a market correction is typically gone. Dividend stocks do not deliver the biggest returns for investors, owing to the fact that the companies are older, mature, and fully grown, yet this does not exclude them from being profitable. Dividends' popularity stems in part from their psychological influence. Successful investing requires the ability to stay committed for the long term, resist the impulse to panic, and trust the investment process. Adhering to these standards is easier said than done in today's volatile markets. Regular dividend payments provide a powerful psychological anchor. Witnessing these dividends roll in on a quarterly basis not only adds to a sense of financial stability, but it also fosters a more relaxed frame of mind. Consistent dividend income provides investors with the comfort they need to remain calm, relaxed, and accomplished, all of which are important qualities in long-term investing. Many Dividend Kings include consumer staples, industrials, and utilities, all of which generate stable income regardless of economic conditions. There are currently 54 Dividend Kings, some of which are well-known household names, such as Lowe's, which pays about a 2% dividend, Pepsi, which pays about 3%, Kimberly-Clark, which pays nearly 4%, AbbVie, which pays slightly less than 4%, Target, which pays more than 3%, and Altria, which pays nearly 10%, among others. Many of them are lesser-known names, such as Black Hills Corporation, ADM, and RPM International. You can get the entire list of stocks by performing a quick online search. The payout ratio is an important indicator to consider when investing in dividend stocks, since it provides insight into a company's overall health. The payout ratio is the percentage of a company's earnings that are paid out as dividends. In general, a payout ratio of less than 50% is preferred, with 35% to 55% being appropriate. Altria's payout ratio is currently at 80%, and its share price is roughly the same as it was 10 years ago. Investors should also analyze the company's earnings growth. Has their earnings per share grown consistently over time, and is this projected to continue? Avoid companies that are unlikely to increase profits. Consider the stability of the industry in which the company works. Industries with constant demand and economic resilience are more likely to support regular dividends and price increases. Examine the company's competitive stance, often known as its moat, which provides protection from competitors. When dealing with dividend stocks, it's best to follow Warren Buffett's lead and invest in sectors you're comfortable with, rather than risking your money on a firm in an industry you don't understand. It's a better idea to concentrate on companies you're familiar with. For example, If you're a frequent Lowe's shopper with a strong understanding of the home improvement business, you'll have insights into the company's operations, such as store efficiency, cleanliness, and staff quality, all of which influence the company's performance. Being knowledgeable with the firm and industry allows you to predict consumer behavior. Are consumers spending their money on home renovation projects? Are they actively renovating their homes? Investing in what you know not only follows Buffett's advice, but also allows you to make more educated decisions based on your own knowledge of the companies and industries involved. Don't assume that a stock identified as a Dividend King is always a profitable investment. Some equities boast extremely high dividend yields because their share prices have been steadily declining for years, if not decades. Consider a scenario in which a stock pays an attractive 10% dividend, but the stock price continually falls by 20% every year, making the investment unprofitable. Furthermore, these equities may have a dangerous payout ratio, raising questions about the company's long-term financial stability. Before pursuing what appears to be a high-yield opportunity, it is critical to go beyond the title and carefully assess the total financial situation. Even the mighty Dividend Kings are susceptible to market fluctuations. Just because a corporation has a prominent label or provides consistent dividends does not make it a risk-free investment. These equities experience the same market volatility as any other company, and the need to raise dividends on a regular basis poses extra risks that regular companies do not face. Essentially, management may feel compelled to continue paying dividends in order to maintain their coveted Dividend King reputation, even if it means potential financial difficulties in the future. When you invest in these stocks, you are relying not only on the market's confidence in them, but also on management to maintain their success, which may be a difficult balancing act when it comes to dividends. To extend your horizons, look into the dividend aristocrats, companies that have continuously increased their dividend payments for the past 25 years. While this alone is an incredible effort, perhaps not as impressive as the 50 years required to become king title, there are still some interesting prospects available. Stocks that are not on either of these lists can nonetheless be valuable. Not every company achieves the title of dividend aristocrat or king, but that doesn't mean they aren't consistent dividend payers. These rankings do not include all of the best dividend stocks. Whether a company chose not to boost its dividend in order to navigate financial issues or had to lower it as a prudent financial measure, such moves can demonstrate responsible management. It is critical to understand that omission from these famous lists does not inevitably signify poor investment potential. There are numerous examples of firms displaying indicators of high-quality investments despite not owning the titles of aristocrat or king. Regardless of a company's classification as a king or aristocrat, investors should look for high-quality enterprises with strong fundamentals, as they are the primary variables impacting long-term stock performance. Dividend Kings can be an effective approach to provide consistent income and financial stability. These companies' 50-year track record of rising dividends suggests that they have a good game with competitive advantages and consistent profitability, and in many cases, they know what they're doing. There are some difficult aspects, including as the psychological roller coaster of market ups and downs, and the hazards associated with alluring dividend payouts. You simply need to be cautious and conduct some research on things such as industry stability and the quality of the management team before becoming overly optimistic about a dividend yield. It's all about finding the balance between a consistent dividend that will cover your bills for a long time and purchasing a stock that will rise in value. As we conclude, I'd like to thank you for watching. I hope you found value in this video and learned something new, and I look forward to seeing you in our future videos. I would deeply value it if you could like this video and subscribe to our channel. Your support will help us to create more valuable content, and we can work together to secure your financial future. What are the key takeaways from this video that you can share in the comment section?